So for those of you that are unfamiliar with the Pitbull Low, this is something that was introduced by a guy named Marty Schwartz. And Marty Schwartz's nickname was Pitbull. And he's the one that first brought this up. In fact, one of my favorite trading books and one of my favorite trading interviews in Market Wizards, and then the subsequent book that was written called Pitbull by Marty Schwartz. Those are two of my favorite trading books. They're just a good read. It's not about how to and whatnot, but if you're looking for a good couple of reads, if you have not read the Market Wizards and the New Market Wizards by Jack Schwager, please do. I mean, literally, that should be the goal for this for this week. All right, so here's how the Pitbull Low works. So here are the basic rules, and I'm going to put that calendar back up. And so what you do is you look for the Thursday or Friday before expiration. So you can see I've circled here on the March calendar, 7th and 8th. That's the Thursday, Friday. You would buy weakness into Thursday or Friday. Some people prefer Friday. Some people like there's no way. The reason most people say Thursday or Friday is those lows tend to happen those two last days of the week. You buy into that weakness, which is a core part of what we do in terms of looking for down days and red grab candles or pullbacks into the wave, things like that, that would allow us to buy some weakness. And we're playing that low. And then we hold it into Monday or even into the coming Friday. I think holding it into expiration is a little bit rarer, but most folks will hold it into Monday or even Tuesday, depending upon whether or not they believe in a turnaround Tuesday or they just want to take profit into the strength on a Monday. So that's how that works, and that's the timing. So conceivably, we're looking for movement higher into the week. Now, there's a few things that have happened in terms of Boeing and the way that's dragging down the Dow, but heck, even the Dow is up today. We were playing pullbacks on the daily time frames of the NASDAQ and the Dow and the Russell and the S&P. So this is a daily follow through, but when you break it down to Facebook, of course, a heavily weighted name within the S&P and the NASDAQ, so a futures trader like myself is going to pay a lot of attention to a name like this. What I want to know first is what is the structure of this market? So the first thing to notice on Facebook is that I do have a really nice uptrend. I've got the consistent green grab candles. They're climbing up the wave. They're climbing up a set of automated moving averages that I use the wave to help draw. So I've got everything in place that I'd want to be long on this trade. So that's pretty simple. So doing a put credit spread or a bull put spread, you're going to buy one out of the money put. You're going to sell one out of the money put. And really, what are you doing? You're collecting the credit. So I'll buy that put at the lower strike. John walked you guys through all of that. And the question I typically get in the futures room when we do talk about options from time to time is, the whole idea is that we're looking for a moderate move to the upside. Nothing major. We're looking for a moderate move to the upside. So you don't want to be doing this on a market that you think is going to necessarily scream higher, right? So what we want is ideally that the stock price closes above the higher strike on the expiration date. So both the options expire worthless. And then what you're able to do is it's a limited upside profit, but you're able to take in the credit when you're entering the position, and you're hoping both those options just go to pot, right? So I want to find a market that's bullish, but not too bullish. I want to find a market that is going to give me an opportunity to see some gradual climb, but not too much. So there are certain things I'll look for. I'd rather the market not have these propulsion dots. So this might still very well work. I think this is a good choice, but I want to find a market that does not have these propulsion dots. I also want to make sure that I'm doing this in a market that's already climbed a little bit off the wave, right? I don't want it right in here because I think the market then could spring higher, and I don't necessarily want that either. So this one's actually a really good candidate. The only thing that gets my concern is the two dots. It has moved higher off the wave, which, by the way, that's the initial entry for us, those pullbacks into the wave, but that could be a conversation for another time. So there's a look at the Pitbull Low. There's a look at put credit spread or a bull put spread, and why I think Facebook is a good candidate for a move like this, but also keep an eye on those red propulsion dots. Those are signs that the 3 and the 8 exponential moving average are showing that the market might blip the throttle a little bit, but I think we should be okay with this one.